Hello everyone, I'm Ankit and you're watching StudyIQ IS English. In our today's video, we'll try to understand why is Government of India laying down on this pile of cash which has been provided to it by the RBI after it has announced a record dividend to the Government of India this year. And the reason why we have picked up this article for our today's discussion is because last week, the Central Board of RBI announced a record surplus transfer of its profit akin to 2.86 lakh crore rupees to the central government. Now, naturally, when this amount of money which will be provided to the central government for the accounting year 25-26 would be a significant boost to its overall fiscal position. On one hand, it will provide much needed non-tax revenue to the government, which it can spend for its other obligations, be it capital expenditures or be it revenue expenditures. And it comes at a very crucial, vulnerable time for the government because it is facing balance of payment crisis, particularly due to the conflict which is happening in the Middle Eastern region between Iran and the US. So let us understand this topic in great detail. Now, first you need to figure out first of all that this topic is a very technical topic. So I'll try to make it as simple as possible for each and everyone who is watching this video to understand it. And as a result, the notes which I will be scribbling on this board throughout the class, if you want to download them, and you should, because these are very important. For that, you need to go to a Telegram channel called as ATS Live. And while you're at it, please do not forget to subscribe to the channel also. So let us begin our today's discussion by understanding the basics of how RBI's record transfer fits into the government's budgeting. Now, whatever government earns every year, they are called as receipts. And these receipts for accounting purposes are divided into two halves. Revenue receipts, which accounts for receipts that the government earns during its day-to-day obligations. And the second kind of receipts are called as capital receipts. Capital receipts are the receipts which government earns by virtue of reducing its overall assets. Now, first let us understand what are different types of revenue receipts of the government. These revenue receipts are further divided into tax receipts and non-tax receipts. Now, for tax receipts, whatever money the government earns through collection of income tax, corporate taxes, securities transaction tax or capital gains tax, these are taxable incomes of the government. There are some other indirect taxes as well which gives revenue to the government, like the goods and services tax, customs duty, excise duty that it collects on the sale of petrol and diesel. These are examples of tax revenue for the government. Now let us talk about what are the non-tax revenues of the government. Non-tax revenue, the highest non-tax revenue of the government is the interest it earns on the loans that it has extended to the state governments or to any other country. Similarly, in addition to interest income, other non-taxes revenue include the dividends which it receives from the government-owned PSUs or from the other government-owned entities like the RBI. So these are major non-tax revenue sources of the government. Now let us talk about what are capital sources of revenue. Here, capital receipts can be divided into debt creating capital receipts and the non-debt creating capital receipts. For debt creating capital receipts are those receipts, for example, the loans taken by the Government of India or the borrowing done by the Government of India through issuing of government securities. On the other hand, the non-debt capital receipts of the government include disinvestment proceeds, which it gets by selling of its companies, or when government sells its assets like lands or companies like Air India, the income that the government earns are examples of non-debt creating capital receipts. Similarly, if the government recovers any loans from which it has given to state governments, that also form non-debt capital receipts. So in this regard, dividend that the government earns from RBI, it is an example of what kind of receipts? A non-tax revenue receipt of the government. Okay, so this is where the RBI's dividend falls under the broader ambit of government's budgeting. Now let us try to understand why does RBI transfer its profits to the government. There are two reasons for it. First reason is that RBI is an entity which is 100% owned by Government of India. So whatever profit that RBI makes, a portion of that profit goes to its ultimate owner, that is the government of India. Second is a legal obligation on the RBI. If you can recall, Section 47 of the RBI Act 1934, it mandates the RBI to transfer its surplus profit to the government of India. So these are the reasons why RBI transfers a portion of its profit to the government. Now, how much portion of this profit is transferred to the government? This is what we are here to understand. To understand how RBI makes profit, you need to understand what all are the assets of RBI. Now, you need to understand in RBI balance sheet, you will see two types of entries: assets and liabilities. Liabilities includes what RBI owes to other people. So you don't naturally make profit from your liabilities. From where do you make profit? You make profit from your assets. Just for example, what are your assets? You have house, you have gold, you have investments. So these are your sources of profit. Similarly, the assets of RBI enables it to make a very huge amount of profit. This is not because RBI wants to make profit, but by design, RBI's operations are such that it ends up making lakhs and lakhs crores of profit every year. So let us understand how does RBI make profit. Now RBI makes profit from multiple assets it have. You can understand RBI maintains a sizable hundreds of tons of gold in its forex reserves. So whenever the value of gold appreciates, the increase in the value of gold is what gives RBI the profit. In addition to its gold, RBI also has sizable portion of foreign currency assets. This includes foreign currencies like the US dollar, yen, pound, euro, and if the value of these commodities increase or decrease, it enables the RBI to generate significant chunk of profit. Similarly, RBI also has bonds which are issued by many foreign governments like US Treasury bond, and these US Treasury bonds and other bonds enables RBI to generate significant amount of interests. In addition to that, RBI is also a debt manager of the government, and in that part, RBI holds a significant chunk of bonds which are issued by Government of India as its parts of its borrowings, called as government securities. So on every government security, like the bonds issued by foreign government, it also helps RBI to earn sizable amount of interest. Similarly, you need to understand RBI acts as a banker to the government, both center and states, and RBI acts as a banker to the banks. So the loans it has given to central government, state governments, or the banks, all these loans help RBI to earn sizable amount of interest. So this increase in value of gold, or the appreciation in the value of gold, appreciation in the value of foreign currencies, interest from bonds issued by foreign governments, Government of India, or the loans it gives to other entities are the ones, those kind of assets which enable RBI to earn lakhs and lakhs of profit every year. Now you must be thinking, what about banknotes? RBI prints very huge amount of banknotes every year. So does it help RBI earn profit? The answer is, on one hand, the answer is no, because all the banknotes are not assets, but they are liabilities of the RBI. So you must have read it in your banknotes, right? The RBI governor promises to pay the bearer of that note the sum amount of the face value of that note which is printed on it. So that means that all the notes are liabilities of the RBI. So RBI does not get profit from printing of the notes. Please remember, RBI makes profit from its asset, the ones that I have enumerated right now. Understood? So these are all the sources of income for RBI. Now, how does RBI make profit? RBI makes profit from its assets like gold, foreign currency assets, government securities, or the loans it has extended to central government, it has extended to state government, or it has extended to the other banks in its role of acting as a banker to the bank. So all these assets generate huge amount of profit, which is called as a gross profit of RBI. Now, is this gross profit transferable to the government? The answer is no. From this profit, RBI would make or take out some money to meet its expenses. Now, what are expenses of RBI? Expenses of RBI includes salaries of its present employee. It includes pensions of its past employees. It includes administrative expenses like running an office, provision of tea, coffee, papers, pens, etc. Whatever RBI must procure in order to undertake its job. All of these are administrative expenses. Similarly, RBI also rents some premises for setting up of its offices. So the rental expenses of the RBI are also enumerated as the expenses incurred by RBI in its day-to-day operations. But here, the most important expenses that you have to understand today is the expenses incurred by RBI in printing and distribution of the banknotes in the economy. And you will be surprised to know every year approximately RBI spends about 5,000 crore rupees per annum on undertaking printing and distributing these banknotes throughout the economy. So all of these expenses are taken out from the gross profit, and RBI is left with what is called as a net profit. Now from this net profit, RBI makes certain provisions for its buffer reserves, right? Or RBI maintains some buffer reserves which it will use to meet any emergency like circumstances. So RBI maintains some reserves, and from the rest of the money, after meeting its reserve requirements, RBI transfers the rest of the money as a dividend or a record surplus transfer to the government of India, right? So this is how the money is divided between RBI maintaining its own reserves and transferring the rest of them as a dividend to government of India. And this is where the controversy actually lies. Now, if you were an RBI governor, what would you want? RBI would want to maintain as much as reserves as it is possible, right? And if you were government, you would want the RBI to transfer maximum amount of money as dividend. And this is where the interest of these two entities come into conflict. Because if you were RBI, you'd want to have a significant chunk of the money as reserves, and if you were government, you'd want the RBI to transfer as much as it can as a dividend to the government of India, because government has many other expenditure obligations and it can rely on these dividends to meet at least some of those expenditures. Now, to solve this conflict, which actually came into fruition in the years of 2018-19, and it led to a very notable tussle between the government and RBI. So to solve this problem, the RBI constituted a committee under the chairmanship of its former governor, Mr. Bimal Jalan. And Bimal Jalan committee actually recommended the formula which would be used by RBI to calculate what percentage of the profit should it use to maintain reserves and what should be the money it should give as to the government every year as a part of its dividend. And this formula, which was suggested by the Bimal Jalan committee in 2018-19, is called as RBI's Economic Capital Framework. And this economic capital framework, which was set up based on the recommendation of Bimal Jalan committee, actually forms the crux which helps RBI to determine how much money it should keep as reserves and how much money it should transfer to the government. So let us try to understand what were the recommendations of Bimal Jalan committee and how would RBI come to finalize its economic capital reserves. Now, in this regard, the recommendations of the Bimal Jalan committee were multiple. The first recommendation of the Bimal Jalan committee, it actually determined how to calculate this profit of the RBI. The Bimal Jalan committee here stated that the profits of RBI needs to be divided into two halves. First is a unrealized profit and another is a realized profit. Now, what is the difference between an unrealized profit and a realized profit? Let us understand this. Now, the difference between a realized profit and unrealized profit, to understand this, we need to get a very simple common example that can apply to you as well as me. This reason or this example you can understand. Suppose today you want to buy a house and this house for you is 50 lakh rupees and you spend this 50 lakh rupees to buy a house. As soon as you bought this house, you put this house on rent, and the tenant will every month give you 30,000 rupees as the rent for renting this particular household. Okay. Now, in the span of next 1 year, suppose the government announced that it is setting up of a metro line near your house. So when such public infrastructure announcements are done in any particular area, the property rates of that area rises. So in the span of 1 year, the house which you purchased last year for 50 lakh rupees, now the value of that house increases to 80 lakh rupees, right? But you decide not to sell this house. Rather, you decide to put this house on rent again for 30,000 rupees per month, right? So in the span of 1 year, you have made two types of income. First income that you have generated is from your rental income. 30,000 rupees per year into 12 would give you 3,60,000 rupees as the yearly rental income. And this 3,60,000 rupees comes to you in form of cash, or it directly enters into your bank account. So please understand, this 3,60,000 rupees is an income which you have realized physically or at least digitally. Now the second kind of an income you have made is appreciation in the value of the house. Now your house, which you bought it last year at 50 lakh rupees, it has increased to 80 lakh rupees. So the income that you have made this year is 30 lakh rupees by virtue of appreciation in the value of the house. But since you decided not to sell this house, this 30 lakh of rupees, you have not realized it yet. Have you made this profit? Yes, but this profit exists on paper. This profit has not come into your bank account, or it has not come to you in form of cash. So this 30 lakh rupees notional profit which exists on paper, it is an example of what? It is an example of unrealized profit. And this 3,60,000 rupees which you have earned every month by virtue of your rental income, adding up to 3,60,000 rupees is your realized profit. Now let us take another example. If you decide to sell this house, so this selling of this house at 80 lakh rupees generate 30 lakh rupees as real profit in form of cash or in form of bank transfer. So this unrealized profit would realize or would become a realized profit when? It would be a realized profit when you decide to sell your house. But since you have not sold your house, this remains an unrealized profit. Understood the difference between a realized profit and an unrealized profit? Now let us get back to our discussion. The RBI's Economic Capital Framework, as suggested by the Bimal-Jalan Committee, stated that every profit that RBI makes needed to be categorized into two categories: unrealized profit and realized profit. And this is how RBI would make profit. Now let us suppose how RBI makes realized profit. Suppose RBI had gotten a foreign currency, so let us suppose a dollar at 80 rupees. Right now, if it sells those dollar in the open market, RBI would get at least 96 rupees per dollar. So RBI theoretically, by selling of dollar, is making 15 rupees every dollar, and this is what? This is a realized income. But all that dollars which RBI right now has in its forex reserve, which it has not sold in the market, value of all those dollars have also appreciated, but all of that appreciated value remains an unrealized profit for RBI. Understand? Same is that with gold that RBI decides to sell and RBI decides to keep. The gold which it has kept, the value of that gold has also realized, and you understand in the past 1 year the value of gold has realized by 40%. So all those appreciation in the value of gold that RBI still retains is an unrealized profit, and if RBI sold those gold in the market, profit that RBI makes from selling of that gold, that would become a realized profit. Okay, so this was the first recommendation of the Bimal-Jalan Committee. The second recommendation of the Bimal-Jalan Committee was that out of all these income, RBI is only going to transfer the realized profit to the government. and all the unrealized profit of the RBI is non-transferable to the government. So only the realized profit will be transferred to the government. This is the second recommendation of the Bimal-Jalan committee. And the third recommendation that the Bimal-Jalan committee made, that all the unrealized profit would go to a particular account called as revaluation reserves. And as you can understand, these are not shareable with the government. So RBI maintains a revaluation reserve, which consists of all the unrealized profit RBI makes every year. Now, what about realized profit? A portion of that realized profit would be used to solidify what is called as a contingency risk buffer. As the name suggests, contingency risk buffer is a buffer or a reserve that RBI maintains to meet its daily contingency. What if the yield of the bonds that RBI holds drops? What if the loans it has given to any entity fails to get repaid back? So how would RBI make provisions for those losses? From contingency risk buffer. So percentage of realized profit would go to contingency risk buffer, and the rest amount of money would be transferred to the government as a part of its dividend. So this was the third recommendation of the Bimal-Jalan committee. Now, naturally, Bimal-Jalan committee also fixed what should be the percentage of total RBI's asset or its balance sheet that should be kept as a contingency risk buffer. And this brings me to the fourth recommendation of the Bimal-Jalan committee. Bimal-Jalan committee in 2018-19 recommended that the CRB of RBI every year, that is the contingency risk buffer, should amount to 5.5 to 6.5% of RBI's balance sheet. What is RBI's balance sheet? Any organization's balance sheet is assets which are equals to its liability. So basically what the Bimal-Jalan committee recommended, that RBI should maintain its contingency risk buffer between 5.5 to 6.5% of its total assets. This was fixed by Bimal-Jalan committee in 2018-19. In last year, 24-25, the RBI Central Board modified this. RBI Central Board stated that from now on, the RBI would maintain contingency risk buffer between 4.5 to 7.5% of its balance sheet. Right? So this was modified last year, and between this number, it would be the responsibility of RBI's Central Board to fix CRB in the range as recommended by the Economic Capital Framework. So how does it work in real life? Let us now understand this. Now let us suppose in the financial year of 2025-26, which was the last financial year, the RBI's total assets were worth 100 crore rupees. Okay, this is just an example. RBI's net assets, you need to understand, is very close to 92 lakh crore rupees. But to simplify or to make you understand, I've assumed that RBI's total asset in 25-26 amounts to 100 crore rupees. From this total assets of 100 crore rupees, let us suppose RBI makes a realized profit of rupees 10 crores. Now, is this entire 10 crore rupees transferable to the government? The answer is no. What did the Economic Capital Framework say? Economic Capital Framework said that you can fix the contingency risk buffer for any value between 4.5 to 7.5% of the RBI's total asset. This year, RBI has fixed that the contingency risk buffer would be 6.5% of its total assets. So what should be the contingency risk buffer? It should be ideally amount to 6.5 crore rupees. Now, before transferring the profit to the government from its realized profit, RBI would check whether my contingency risk buffer is 6.5 crore or not. If the contingency risk buffer is equal to the value as fixed by the RBI central board, then the entire profit would be given to the government. But what if, let us suppose from last year, the contingency risk buffer reduced to rupees 3 crore rupees. Is it enough for the contingency risk buffer as set by RBI this year? No. So if RBI made a profit of 10 crore rupees and it wants to keep CRB of 6.5 crore rupees, but it checked that its CRB is less than 6.5 crore rupees, that is 3 crore rupees. So RBI would make a provision. From the 10 crore rupees of profit, RBI would transfer some of them, that is 3.5 crore rupees, to make it 6.5 crore rupees as recommended by the RBI's central board. So when CRB becomes 6.5 crore rupees, now RBI is left with how much? If you minus 3.5 crore rupees from here, RBI is left with 6.5 crore rupees as the rest of the money after provisioning or after sending the money to CRB. So this 6.5 crore rupees is now transferred to Government of India as dividend. Let me explain it to you again. First, RBI maintains some assets. Let us suppose it is 10 crore rupees. Now from this asset, RBI makes a realized profit of 10 crore rupees. Is this entire 10 crore rupees transferable to the government? The answer is no. What RBI has fixed this year is that its total asset should be equal to 6.5 crore of its total assets. 6.5% of it should be maintained as CRB. If CRB is equal to 6.5 crore, the entire profit will be sent to the government. If it is not 6.5 crore rupees, then RBI would, from its realized profit, make provision for the CRB so that it becomes equal to the threshold. And after making it equal to the threshold, whatever profit is left with RBI, that will be transferred to the government as a part of its dividend. So basically, the profit that goes to the government as dividend depends on how much provisioning RBI makes for its CRB. If CRB increases, profit to the government reduces. If the CRB reduces, profit to the government increases. Understood? Last year, for example, in 24-25 financial year, RBI fixed CRB as 7.5% of its total assets. And that is why last year the profit sent by RBI was 2.69 lakh crore. This year, less CRB, so more profit has been sent, 2.84 lakh crores. Understood? So this was the crux of entire discussion. Right? Now let us understand, before concluding our today's session, what have been the trends in the dividend payout by the RBI to the government. This year, government has received more than 2.86 lakh crore rupees as a dividend, which is about 18,000 crore rupees more as compared to last year, 2.68 lakh crore rupees. Similarly, a year before that, it was less, 2.10 lakh crore, and a year even before that, it was 87.416 crores rupees, right? So this is thousands of crore rupees. From what we have understand from this slide, from 22-23 till 25-26, every year the amount of profit transferred by the RBI to the government is on a rise. But what about a larger time frame? What has been the trend in this regard? The trend in this regard has been somewhat uncontinuous or discontinuous. In the last 5 years, this has progressively increased, but this is zig and zag in the past few years. This increased on this year when the RBI announced the economic capital framework, but after that RBI's profit declined and so has the dividend. But since the past 5 years, this dividend payout by the government or by the RBI to the government has increased. Understood? So this is the broader trend that we have understood with respect to the dividend payout. So once again, to conclude, RBI's economic capital framework says that only the realized profit is transferable to the government. The profits, unrealized profit, goes to revaluation reserve, which is not shareable. Only the realized profit is shareable, and a portion of realized profit goes to maintain contingency risk buffer. And only after maintaining the contingency risk buffer equal to the threshold of the value fixed by Central Board of RBI based on ECF's recommendation every year, then only the rest of the money is transferred to the government. Understand? Now, before we conclude, there is a very important announcement. The topic that I did just now, I have taken from current affairs, which is an essential part also of the static portion of economy syllabus, which you require for your UPSC exam every year. I teach economy in StudyIQ IAS. If you have liked this, what you can say, the entire economy will be covered in resolution batches, which are basically foundation batches where everything from prelims to mains to interview, we cover everything, with not just with the economy but with respect to all the subjects of UPSC as well. To take admissions to these batches, just go to our website, and before making the payment, if you apply this code ATS live for batches belonging to 2027 exams or 2028 exams, no need to worry about it. Just apply this code ATS live. You're going to get maximum discounts. Now, based on this question, a question was asked in the UPSC in prelims last year. Just look at the question. Which one of the following are the sources of income of the Reserve Bank of India? Let us try to solve this question. Buying and selling of government bonds obviously makes RBI a handful amount of profit. It is a source of income. Buying and selling of foreign currency, yes, it is a source of income this year, particularly the selling of foreign currency assets in the open market to prevent depreciation of rupee, and the appreciation in the value of gold has what led to record profit generated by RBI. Does RBI involve itself in pension fund management? No, it does not. Does RBI act as a banker to the private companies? No, these are generally done by the scheduled commercial banks of India. Now, what about printing and distributing currency notes? Are these sources of income of the RBI? No. It is basically an expense that RBI incurs every year, amounts to roughly 5,000 crore rupees per annum. So this is not a source of income, rather this is an expense. So from this question, what is the right answer? 1 and 2, that is option A is your right answer to this question. So how are you able to solve this question? Because you have understood this topic in great detail in as simple manner as possible, right? Now to download the notes, just go to our web Telegram channel. This Telegram channel is called as ATS Live, where I'll upload this annotated slide. Please refer to the slide, and if you have any doubt, do let me know in the comment section of that. I will happily address your doubts. So this is all from my side for today. We'll keep doing such kind of videos from time to time. Do let me know how do you like it in the comment section, and I'll take your permission. Please have a very good night.